To succeed at investing, it pays to anticipate the stock's breakout well before it makes its move. That way, you'll be prepared when the stock reaches its ideal buy point and ready to pull the trigger without getting bogged down by doubt. Casual shoemaker Crocs, ticker CROX, posted triple-digit quarterly sales and earnings growth after the company's February 2006 public offering. Subsequently, the stock responded with big gains. But Crocs shares didn't take off right away, plodding through 7 months of iffy consolidation before catching fire. If you were a buy and hold investor, you would have been waiting for months before any gains occurred. Investors who charted out proper buy points dove in just as the stock started its big run-up. Those who didn't chart out a proper buy point would have been shaken out before Crocs made its big move, missing the ensuing gains. In May of 2006, Crocs made a new high, but reversed and closed at the bottom of the day's range, a potential warning signal shown at point 1. This move did not demonstrate a proper cup-shaped chart pattern, which creates a higher risk when purchasing. The stock then reversed and moved lower over the next few months. Note that the price did not drop severely, but was in a manageable 20 to 30% range. Trading volume began to pick up in August. The stock spiked on August 4th at point 2, but the stock hadn't completed a proper base, suggesting that Crocs still had work to do. Price and volume action turned bullishly quiet over the next few weeks as Crocs formed a handle. The buy point was $30.85, 10 cents above the top of the handle at point 3. Crocs jumped 6% on September 25th, marking a clean breakout at point 4. As a rule, if a handle forms in the lower half of the previous base, then the stock may have more work to do before breaking out. In Crocs' case, note that the midpoint of the handle was lower than the midpoint of the base. This is a bit tricky in this case because if you strip out Crocs' out-of-character reversal on May 5th, the handle appears sound. Cautious investors could have waited for a handle in relation to the previous high at point 1. In late September, the stock started etching another handle with a 35.15 buy point. It staged a fresh breakout October 10th, point 5, in heavy volume. Because the stock rose more than 20% in less than 3 weeks, it triggered the 8 weeks hold rule, where rather than selling to collect the 20% gain, hold the stock for over 8 weeks to see if further gains occur. Crocs proceeded to make a 100% gain, which is wonderful if you're trying to generate the funds needed to reach financial independence. An investor must always be wary, though, and learn to take profits when they occur. After rising for 8 months, the stock exhibited a large drop in price, which can warn of a future decline. Savvy investors could have heeded the warning and locked in the massive profits. If after a run-up an investor thought they'd profit by purchasing the stock as it moved lower, thinking that they were getting a great value, the stock was a great disappointment, as the stock retraced all of its gains and took 13 years before again reaching those previous highs. That's a long time to wait to recover your money, and in the meantime you'd have missed out on many other profitable investments. In 2020, Crocs again formed a proper cup with a 4 weeks tight handle in low volume. The stock then broke out on heavy volume again, triggering the 8 weeks hold rule, and eventually gained an amazing 300% before consolidating. Crocs is currently working on building the right side of its base, but it's a long way from a proper buy point. If you enjoyed this video, please consider liking and subscribing. Cheers!